What if I told you that the exact same simple investment strategy used by millionaires, retirees, and financial experts could turn just $500 a month into over $1 million, and you don't need to pick a single stock, time the market, or stress about daily price swings? Stay with me, because today I'm revealing the ultimate 3 ETF portfolio strategy for building wealth in 2026 and beyond. Introduction: setting the stage. Here's something that might shock you. According to the Federal Reserve, less than 43% of Americans personally own stocks. And when researchers ask the 57% who don't invest why they're sitting on the sidelines, the two biggest reasons were having no money to invest and not understanding the stock market. But here's the truth. You don't need to be rich to start, and you definitely don't need to be a Wall Street genius to build serious wealth. What you need is a simple, proven system. And that's exactly what this 3 ETF portfolio provides. It's the same approach that financial advisors recommend to their clients, that Vanguard builds into their target date funds, and that countless everyday Americans have used to go from zero to millionaire status over time. So if you've been waiting for the perfect moment to start investing, if you've been confused by all the noise about meme stocks and crypto and AI, or if you just want a set it and forget it strategy that actually works, then you're in the right place. And by the way, I'm going to show you the exact math on how $500 a month can grow to over $1.1 million. Stick around, because the numbers are going to blow your mind. Section 1. Why ETFs are the ultimate wealth building tool. Let's start with the basics. What exactly is an ETF, and why are they so powerful? ETF stands for Exchange Traded Fund. Think of it like a basket that holds hundreds or even thousands of different stocks all bundled together into one single investment. Instead of trying to pick the next Amazon or Tesla, instead of gambling your hard-earned money on one company that could soar or crash, ETFs let you own a piece of the entire market. And here's what makes them perfect for everyday investors. First, they're diversified by design. When you buy one ETF, you might be buying tiny pieces of 4,000 different companies at once. Second, they're incredibly cheap. The 3 ETFs I'm about to show you have expense ratios as low as 0.03%. That means for every $10,000 you invest, you're only paying about $3 per year in fees. Compare that to actively managed funds that charge 1% or more, and you can see why ETFs are a game changer. Third, they're simple. You don't need to analyze earnings reports, read financial statements, or watch CNBC all day. You buy, you hold, and you let time do the heavy lifting. In 2025 alone, American investors poured a record $1.5 trillion into ETFs. In January 2026, the market saw another $156 billion flow in, the strongest January start ever. Smart money is moving into ETFs for a reason. Now let me introduce you to the 3 specific ETFs that form this wealth-building machine. Each one has a specific job, and together they create something powerful. Section 2. The first ETF, VTI, your growth engine. The first ETF in our portfolio is VTI, the Vanguard Total Stock Market ETF. This is your growth engine, the powerhouse that's going to push your portfolio higher over the decades. When you buy VTI, you're buying ownership in over 4,000 American companies. Apple, Microsoft, Google, Amazon, Tesla, Nvidia, and thousands of smaller companies you've never heard of, but that still contribute to your growth. With one single purchase, you own a piece of the entire United States economy. Here's what the numbers show. Over the last 30 years, VTI has delivered a compound annual return of about 10.2%. In 2023, it returned over 26%. In 2024, nearly 24%. In 2025, over 17%. Now, will every year be a winner? Absolutely not. In 2022, VTI dropped almost 20%. But that's exactly why this strategy works. You don't panic. You don't sell. You keep buying because historically, the American stock market has always recovered and gone on to new highs. Think about what owning VTI really means. When American businesses grow, when technology advances, when companies create new products and expand into new markets, your portfolio grows right along with it. You're not betting on one company. You're betting on American innovation and economic growth. And that's a bet that has paid off for over 100 years. But what happens when the American economy slows down while the rest of the world is booming? That's where the second ETF comes in. Section 3. The second ETF, VXUS, your global expansion. The second ETF is VXUS, the Vanguard Total International Stock ETF. This is your global expansion play. Here's something most American investors don't realize. There are incredible companies outside the United States that are driving massive growth. Toyota in Japan, Samsung in South Korea, Nestle in Switzerland, LVMH in France, Alibaba in China, BMW in Germany. These are some of the largest and most profitable companies on the planet, and VXUS gives you access to over 7,000 of them across Europe, Asia, Africa, and emerging markets. Why does this matter? Because diversification is your best defense against risk. Sometimes the American market struggles while international markets thrive. In 2017, international stocks actually outperformed U.S. stocks. Having VXUS in your portfolio means you're not putting all your eggs in one basket. You're spreading your risk across the entire global economy. In 2025, VXUS was actually the ETF inflow leader, attracting over $23 billion from investors who understood the importance of global diversification. Financial analysts are calling VXUS one of the top diversification tools for 2026, especially for portfolios that are too heavily concentrated in American stocks. Now, here's where most people make a mistake. They load up on stocks and forget about the one thing that protects them when everything goes wrong. Section 4, the third ETF, BND, your safety net. The third ETF is BND, the Vanguard Total Bond Market ETF. This is your safety cushion, your protection during market storms. I know bonds aren't exciting. They don't make headlines. They won't double your money overnight. But here's what they will do. They'll help you sleep at night when the stock market is crashing. When stocks fall sharply, like they did in 2022 when the market dropped almost 20%, bonds often stay stable or even rise in value. BND holds thousands of U.S. government bonds and investment-grade corporate bonds, meaning your money is spread across some of the safest financial instruments in the world. Think of BND as the shock absorber in your portfolio. It smooths out the bumps. It reduces volatility. It gives you something solid to hold on to when fear is driving everyone else to panic sell. And in 2026, with interest rates and inflation still creating uncertainty, having bonds in your portfolio is more important than ever. BND currently offers about a 3.9% dividend yield, meaning it's actually paying you just to own it. That's real money hitting your account every single month. Section 5, how these three ETFs work together. Now here's the magic. VTI gives you growth. VXUS gives you global expansion. BND gives you stability. When combined, they form a complete long-term wealth-building machine. This portfolio is used by millionaires, retirees, beginners, and professionals because it works in any economic condition. When the market is booming, VTI and VXUS push your portfolio higher. When the market crashes, BND provides a cushion. When the U.S. slows down, international markets pick up the slack. So what's the right allocation? That depends on your age and risk tolerance. If you're young and aggressive, you might go 80% VTI, 10% VXUS, and 10% BND. If you want more balance, try 60% VTI, 20% VXUS, and 20% BND. Many financial advisors recommend keeping international stocks between 20 and 40% of your equity allocation, and bonds should increase as you get closer to retirement. The beauty is simplicity. 3 funds. That's it. No complicated strategies. No watching the market every day. just consistent investing month after month. All right, now let's talk about the numbers that will change how you think about your future. Section 6, the power of compound interest, real numbers. If you invest $500 per month into this 3 ETF portfolio and earn the historical average return of about 10%, here's what happens. After 10 years, you'll have around $102,000. After 20 years, you'll have approximately $380,000. After 30 years, you'll have over $1.1 million. Read that again. $500 a month, 30 years, over $1 million, and it gets even better. If you can invest $800 per month, you'll have over $1.8 million after 30 years. If you can invest $1,200 per month, you're looking at over $2.7 million. This isn't magic. It's not a get-rich-quick scheme. It's simple math plus time. The money you invest today starts earning returns. Those returns earn their own returns. And over decades, this snowball effect transforms modest monthly contributions into life-changing wealth. Here's the key insight that separates wealthy people from everyone else. Most millionaires didn't get rich overnight. They got rich by investing every month, staying patient, and letting compound interest work for them. The average American's 401k balance is only about $144,000. But those who stayed consistent for 15 years or more, the average balance for women alone who invested consistently for 15 years crossed $500,000 in 2025. Section 7. Common mistakes to avoid. Now let me warn you about the mistakes that destroy portfolios so you can avoid them. Mistake number 1, chasing performance. Just because an ETF did well last year doesn't mean it will this year. Stick to your plan. Mistake number 2, panic selling. In 2022, investors who sold during the crash locked in their losses and missed the massive recovery in 2023 and 2024. The market dropped almost 20% in 2022 and then bounced back over 26% in 2023. Mistake number 3, trying to time the market. Research shows that investors who try to time the market see drastically lower gains than those who simply invest consistently through dollar-cost averaging. Mistake number 4, not starting because you think you need more money. You don't need $10,000 to begin. You can start with $50. What matters is starting. Section 8, how to get started right now. Here's your action plan. Step 1, choose your brokerage. Fidelity, Vanguard, Charles Schwab, or Robinhood all work fine. Step 2, search for VTI, VXUS, and BND. Step 3, decide your allocation based on your age and risk tolerance. Step 4, set up automatic monthly investments so you're investing without even thinking about it. And then here's the most important step. Do not stop. Do not panic sell during crashes. Do not jump from one strategy to another because of fear or hype. Stay consistent. Stay invested. Stay patient. Now here's my question for you. Are you going to be part of the 57% of Americans who never invest and wonder why they can't get ahead? Or are you going to join the people who are quietly building wealth every single month, setting themselves up for financial freedom? The difference between where you are today and where you could be in 10, 20, or 30 years comes down to one decision: the decision to start. Drop a comment below and tell me, are you ready to begin your wealth-building journey? What's holding you back? I read every single comment and I want to hear from you. If this video opened your eyes to what's possible, smash that like button. Share it with someone who needs to hear this message, and if you haven't already, hit subscribe and turn on notifications because I'm dropping more wealth-building strategies that could change your life. Your future self will thank you for watching this video today, but more importantly, your future self will thank you for taking action. Now go start building your 3 ETF portfolio. I'll see you in the next video.